privacy planning. And we are going to use Drake, Drizzy Drake. I don't know. He's got all these nicknames. We're going to be talking about Drake today. He has done a bozo move in using LLCs for non-disclosure agreements. He has blown his asset protection and he has blown his privacy planning. So don't be like Drake. Okay, we're going to use him as the example of what not to do with your LLCs today. Now, I'm going to get into why you may want to have privacy protection and using an LLC to get privacy. We'll also talk about how the asset protection works in an LLC and the benefits there. Those are two different things that we're going to talk about today. Privacy planning is different from asset protection planning. And the LLCs and the structures you may use and the reasons and options you have are different in privacy planning versus asset protection. So we're going to break those down into two separate categories. Now, I'm Matt Sorensen, wealth lawyer, award-winning entrepreneur. I've been a lawyer setting up thousands of LLCs and corporations for clients across the country. My law firm, KKOS Lawyers, sets up 500 entities a month for clients across the country. And we are paying attention to clients who want privacy planning. We're paying attention to clients for the asset protection planning that they want in their specific situation. So I want to break down the rules and things everyone should know, whether you're an A-list celebrity like Drake, or whether you're a small business owner, working on Main Street America, or building up your wealth and your American dream. I want to talk about how you should be setting up the LLC and thinking about it for privacy and asset protection. Okay, now I'm going to be sharing some little diagrams here as we go through this, but I want to give some context to how Drake has fallen into the news and how his LLCs are even a point of topic right now. So Drake has been in some beef with Kendrick Lamar, I guess. I don't know. I don't follow this. My team tells me what's going on. And it's been alleged that he is using non-disclosure agreements to silence women, that he's been using these to silence potential physical or sexual abuse or criminal activity with women being involved. I don't know if this is true, and who knows where these allegations are coming from specifically. There's no court cases or anything I'm aware of that, but this is just the allegations floating around in the internet. Not what I want to talk about today. Instead, I want to talk about the LLC that has been alleged he is using to sign non-disclosure agreements with people for. Now, a lot of celebrities use non-disclosure agreements. Tom Cruise has used them. Jennifer Lopez has used them. Good old J-Lo. Mel Gibson, Taylor Swift, Justin Bieber, Mariah Carey. They've all used non-disclosure agreements for people that they've been in relationships with. So this is not something that's like crazy using a non-disclosure agreement. Now, when do business owners use a non-disclosure agreement? We might do a whole separate episode on that. But maybe you're selling a business, you're entering into an agreement with another company where you're disclosing information about your business or confidential information or trade secrets or financials. You might enter into a non-disclosure agreement that says, hey, we may be disclosing confidential information between each other. You agree not to disclose that to anyone else. That's what's called the non-disclosure agreement, or sometimes called an NDA. So the allegation is Drake had been using these, particularly with people he had relationships with, intimacy with, and that they were being used improperly. And some women feel like they've been silenced for abuse or things that Drake has done. Who knows? There's a lot of news going on about P. Diddy right now about this now. Again, I want to just focus on the LLC because Drake's LLCs are a total disaster. I hate to say it, but the way he's done his LLCs, absolute freaking disaster. The whole purpose of signing a non-disclosure agreement, what Drake's trying to do, is to get people to not know that this information is out there or these LLCs even freaking exist in the first place. So let's look at the LLC he has filed. He set up a Delaware LLC, by the way, and registered it foreign into California. Now let's pull up the California filing here. We're going to show that on the screen so you can see what he actually filed in California. Now, when you file an LLC, we're going to get into the details here that everybody needs to know. Every state, you're going to file either articles of organization or a certificate of formation. One of the two, every state has it that says, hey, what is the name of this LLC? What's the business address for the LLC? Who's the manager? Who's the member? Who's the registered agent? I'm going to go through those three areas and how you can get privacy by focusing on what to put on the document. But what Drake did in his California filing is he filed what's called a statement of information, which is required for every LLC in California. And in that statement of information, he disclosed that he's the manager of the LLC. He just put his name on it, as manager of the LLC or member. Now, if you're someone trying to invoke privacy. You're someone who called the LLC Silence Policy LLC. The whole name of the LLC tells you what he's trying to do, which is another bozo move. He called the LLC Silence Policy LLC. And this is what the entity it's been alleged he's been using to sign non-disclosure agreements. Now, his name is right there on it, Aubrey Drake Graham. That's Drake. He's right there listed on there as the manager of the LLC. Now, if you're someone trying to be private about your assets or your personal life or things like that, you would not put your name on the LLC. Obviously, that'd just be stupid. Now, Drake probably doesn't know who did this, or it's probably his business or management or lawyers who are not paying attention or focused on this. But this is an LLC I'm sure Drake would want to have privacy on. Now, I'm going to break down later here in a moment the 3 things you have to get right on an LLC to make it private. You've got to get the manager listed right. You've got to get the member listed right. You've got to get the registered agent listed right to get entire privacy where no one knows you own an LLC. But we're going to get to that in a minute. You can't do it in every state. I'm going to break down the states where that works and where it doesn't. And in the states where it doesn't work, I'm going to give you a workaround where you can still get privacy. Now, Drake didn't do any of that here. So as we walk through what you should do right, we're going to be looking back at Drake to see, don't be like him because he did it wrong. All right, now let's look at Drake's overall board here because I'm going to talk about privacy here for a moment. If you look at his overall diagram, this shows 23 LLCs that Drake has. Now, for a lot of business owners and individuals, even myself, I'm not super focused on privacy. I'll just be honest with you, that's not really critical to me, but I know a lot of our clients are, a lot of celebrities, public officials. We have a lot of real estate clients who don't want their, they have thousands or hundreds of tenants. They don't want them to know who they are or where they live. They don't want them showing up at their house when they're evicting, when they have to get victim, you know what I mean? And so they want some certain level of privacy. For me, with my entities and businesses, I'm like the name. I want people to know I own these companies, like I want people to know I'm the founder of Directed IRA, that I'm one of the managing partners, senior partners at KQS Lawyers, and I'm one of the principals and founders of Main Street Business Services. Like I'm out there talking about it and trying to build these businesses, and I'm public about it. And so for a lot of these entities on Drake's org board here, you can see his name should be on it. I mean, his event promotion businesses, his products that he's selling, his clothing and his line and everything. It's obvious his name should be on the filing for those entities. And it just should be. I don't see any reason why it shouldn't. But if you're going to do an entity where you're having people sign non-disclosure agreements and you're calling it Silence Policy LLC, don't put your freaking name on it. Duh. Not so silent there. So if you are someone that's like, I really need privacy, Matt, and I've had that. I've had Grammy award-winning artists as clients owning lots of rental real estate that wanted privacy protection too. They didn't want the tenants in these properties to know that some freaking Grammy award winner is the landlord of it. They didn't want that. Now, their company, their promotion company, their events, their tour, all that, their merchandise and all that stuff that they promote, sure, throw your name on those companies and entities, but maybe our assets and stuff, we want to be a little more private about how we are listed on those and who knows what we own. Now, there's a number of ways you can get there, but let me just talk about the first way. Now, I mentioned just a moment ago, when we're talking about privacy, you have to nail 3 things. See, when you file an LLC or even a corporation, you have to list to the state a number of important information. And this is just to get it approved and get that entity active with the state. You have to list a certain amount of information. As I mentioned a moment ago, this is usually your articles of organization or certificate of formation. Now, on this document, it will list what is the name of the LLC, what is the address of the LLC, what is the registered agent address, and who is the registered agent of the LLC. This is the person or company who receives service of process. And then who is the member and who is the manager. Now, those 3, registered agent, member, and manager, are the 3 ones you've got to nail where you don't want to have your name on there to get privacy. Now, let's walk through the list here. Let's talk about member first. Member is like owner of the LLC. Now, most states, you do not have to disclose who the member is unless you choose to do what's called a member-managed LLC. In our law firm, we never set up member-managed LLCs for this very reason. We don't want to disclose who the owner is. Why would I do a member managed LLC and disclose who the owner is? Instead, we will do a manager managed LLC. Every state has an option to do member managed or manager managed. Always do manager managed. In a manager managed LLC, you just list who is the manager. You don't know who owns it. This is just who's the manager of the LLC. So by listing manager managed LLC, we only have to list who the manager is. Now, in Drake's instance, he listed that he was the manager of the LLC. So you can presume he may own it. And you might want to think about that for yourself in your own LLCs. Do I care that I'm listed as the manager of the LLC and people know that I own it? You may not want that. You may be like, nah, I don't want my name on this thing at all, whether people know I own it or whether I'm just a person managing it. I don't even want my name to be touched or anywhere appear on this thing, on any entity with the state. Okay. Here's a couple ways you can get around that. One, you can use a company to be the manager. Some people have a management company for privacy purposes that would be in a state like Wyoming, which I'm going to get here in a moment, that it is not clear who owns that, and the entity itself is the manager. So on Drake's LLC here, where it lists manager on the statement information in section 5, instead of listing an individual, he could have listed an entity. And it could have been an entity under his control that was in another state where you do not have to list members or managers at all. So his name may not have needed to be on this at all. He could have listed a company in section 5 here on the statement of information as the manager. And that company, if you then trace that company, let's say you call it XYZ LLC, and it was set up in Wyoming, where in Wyoming, you don't have to list who's the member, manager, or you can list somebody else as the registered agent. And so that can be totally private in Wyoming. Meanwhile, we use that into California as the manager. Now, registered agent is easy because registered agent, you can just list a company as registered agent. In Drake's instance, he used a company called E-Registered Agent Inc. I don't know. We have our own registered agent company called Main Street Registered Agent, which is in all 50 states, and we serve as registered agent. Registered agent means it's the company that receives a legal process or lawsuits, essentially legal notices on behalf of the company. You have to list a person or company in that state. He listed a registered agent company in California, and so his name wasn't there, nor was his personal address there. And this is an important point too, because a lot of people may not care that their name is listed on an entity. Like even myself, on my companies, my name is on them and such as the manager or president or whatever it may be, but my personal address isn't. I don't want my personal address on there. So I list business addresses. And some of you that may work from home or be real estate investors, you don't have an actual office address, you can just list a registered agent company's address, which again, we have in all 50 states, and then your personal address isn't on there. So you have address privacy so that no one knows where you personally live. Again, particularly landlord tenants, I know this is important too, and some business owners too just still want to have a little privacy about where it is that they live. All right, now let's dive into some of the states where you can get immediate privacy protection if you set up the LLC right. Now, there are two main states that we will use and that most good lawyers will use for privacy planning, where we're going to use an entity and keep it private. The first state that we like the most is Wyoming. In Wyoming, you do not have to list who the member is, who the manager is, and you can list a registered agent that is a third party or just a company. And we charge $125 a year to be your registered agent, so it's not a significant cost. So that's easy right there. I can go right to Wyoming, do a Wyoming LLC. Nobody knows that I own it. Now, if I have a California LLC like Drake, Silence Policy LLC here, this is the statement information I'm looking at. When I go to file that and I list the manager or member, I'm going to say it's manager managed, and I'm going to list my Wyoming LLC, XYZ LLC, as the manager. That way, as I'm operating California, nobody knows that I own it. Okay, so that's a way that I could use that Wyoming LLC, but also benefit myself in other states. Now, this strategy of using Wyoming LLC, some people also like to use New Mexico. It's in and of itself. And you might, by the way, just have like investment accounts and stuff, and you don't have to have a California LLC or another LLC in the state where you live. You can just use the Wyoming LLC directly to hold other assets. Now, if you're owning real estate or you're doing business in California like Drake is, I don't know why he has Silence Policy LLC doing business in California, but whatever. So you could then still use the Wyoming LLC to again serve as the manager. Or if it's like just investment accounts and there's no business being conducted in another state, you could just do a Wyoming LLC to start with. Now, the other state is New Mexico. New Mexico is the other state where you can have total privacy, where you don't have to list the manager, the member, and you can also just list a separate registered agent company. Now, most other states, besides those two, Ohio's kind of one we've heard about over the years, but I haven't loved that one as much. But I really like Wyoming. That's what we use for most of our clients because there's other good asset protection benefits to it. And then New Mexico. Now, am I telling you all you need to go set up a Wyoming LLC to get privacy? No, I don't do this. I already told you that. But I'm just saying there's a lot of people who want privacy and frankly who need it to build their assets and their net worth. And they don't want people knowing about what's going on in their business. They think that's a huge value to them. That's not me. I'm obviously public about this. I talk about all my stuff here on YouTube and social media. So it's not like I'm trying to hide stuff. So if you want privacy planning, make sure you're considering states where you can get total privacy protection. Think of Wyoming. And think of using those Wyoming entities, by the way, to serve as manager in other states or member sometimes. And you got to make sure you're planning this right. There's so many tax and legal issues there, and in changing out who the member is. Who the manager is easy. There's a lot of repercussions to that. So make sure you're getting a good consult. My law firm sets up entities in all 50 states for clients that can advise you through this if you're super focused on being private in your privacy planning. Now, this is separate from asset protection, okay? Think of my partner Mark always likes to refer to, my law firm partner Mark likes to always refer to privacy planning as camouflage and then asset protection as armor, right? And so the camouflage is like, I don't want people to see me or see what's going on in my assets and what's going on in my business, but then I want the armor and protection of an LLC in case there's a liability. So let's break down asset protection here. I'm going to use the whiteboard for a moment. A lot of you are familiar. We do our trifecta. You do operations over here, and you hold assets over here. And this is you down here. You have your 1040 tax return. You should have a trust for estate planning. Over here, you got your operations, which is usually an S Corp. Make sure you watch my video, by the way, on Joe Biden and how he used an S Corp. I'm doing another one on Jill Biden and how she's used an S Corp to save taxes. Every small business owner should be using an S Corporation. Now, LLCs, we're usually using for assets. This could be a rental property or things like that. Now, in an LLC, the asset protection is something happens in the business, there's a lawsuit, tenant slips and falls, they're forced to sue the LLC. They can't come down to me as the owner here personally and get at my personal assets. So the assets of the LLC are the only thing at risk. That's the limited liability. That's what LLC stands for in an LLC. And so I'm separating my business risks from all my personal assets and all my other assets. That's the asset protection that you get in an LLC. That is totally different from privacy. Privacy is about someone being able to figure out what you own or someone looking up your stuff like Drake and stumbling into Silence Policy LLC that's being used for non-disclosure agreements. Okay, so those are the two goals there. If I'm trying to get privacy protection and do privacy planning, and I'm trying to get asset protection, I got to make sure I'm focused on what I'm putting into the LLC itself in the member, manager, and registered agent section. And don't try to do this on your own. If you're really trying to get privacy planning, you must have assets worth protecting. You must be someone of significance. Make sure you're using a lawyer to do that. I don't even know who Drake used to do this. I don't think they thought this through very well, frankly. And so make sure you're using a lawyer. Our team can help. You don't have to use our law firm, but go get a lawyer that's smart on this stuff. And but then the second thing is you can use those entities, remember, in other states where you can list that. Let's say this Wyoming LLC is the manager here on a California entity. Now, the asset protection benefits are still there, as I talked about. Any lawsuits that happen in that entity are contained in the entity itself. They can't come after your personal assets. All right, do you have any questions on privacy or asset protection? I know we've got a lot in the hopper on retirement account questions, but I want to just check in and see. I was kind of going on a rant there for a little bit.
Yeah, there is one question. We got this one from YouTube. When I was opening an account with Chase for my LLC, they insisted on me providing my social security number. Should I be concerned about this?
Okay, good question. You should not be concerned about this because the bank is required to obtain this from you to open up the bank account for the LLC. Now, When I'm talking about privacy planning, I'm talking about privacy with respect to the general public, not with respect to the bank that has to obtain that information for their customer information policy, their CIP policy, their BSA requirements for banking rules. They have to understand who owns more than 25% of an LLC. So, frankly, you have to disclose that to a bank to get a checking account in the LLC's name. And so, there's no way around that. But that's not going out to the public. That's a disclosure just to the bank. There's also the FinCEN BOI filing that you have to file now with the federal government. But again, that's not public. You have to disclose who owns 25% or more, who's a responsible person, but that's not publicly available. What we're talking about here in privacy planning, making sure you're filling out your articles of organization or your certificate of formation, right? Or in Drake's case, the statement of information, we're talking about being private with respect to the general public. I don't want the general public to be able to Google, which our team freaking did in 5 minutes to find this LLC of Drake's. And so you will need to disclose your information to banks, government agencies and stuff with respect to the business. But those agencies and the banks, of course, need to keep that information confidential. It's not out and available to the public. But great question there. But remember, privacy planning is about the general public. And really what we're thinking about there is potential plaintiffs, people that may want to sue you or just frankly get into your business that it's none of their business to see what you own and the assets that you have. All right, now let's go over, I just want to talk about some of the questions that came up already. Some of these came in from the last live. We pulled a lot of your questions from YouTube. A lot of these are retirement tax based, but I'm going to focus on some of the business ones first here. And just bear with me for a moment while I get those ready. All right. Where are my questions? Sorry, I got a million things going on here. Let's see where the questions went. Oh, here we go. Okay, so these are the questions that came in from YouTube. Sunshine Girl asked, are DBA names required to be unique in the state, just like LLCs? Yes. If you're getting a DBA, some states call it a fictitious name, that has to be unique. It's going to get ran against other names of LLCs and DBAs in that state. And if there's someone else using that, it's going to get rejected. So if you're doing a DBA, which means doing business as, or a fictitious name, that's what they call it in certain states. Some states even call it a trade name to make it more complicated. That's all the same thing. It's not a legal entity. It's just a resignation and designation of a specific name to do business under. Like, for example, Directed IRA is just a trade name. The company name is Directed Trust Company, but we operate under Directed IRA as a trade name, and we've trademarked that too. So KQS Lawyers is a DBA. It's in that state. It's a DBA. But the actual official name of the entity is Kyler, Kohler, Ostermuller, and Sorensen LLP. And so so those trade names DBAs still need to be unique, but they're not a legal entity itself. It's just kind of a name you can use that is attached to the entity. All right, let's get into some of the questions here. I've got a lot on retirement accounts. So let's just dig into some of the retirement account questions. Jody asked, hi, Matt, is it better to cash out one of my 457 accounts later this year, pay the taxes, and roll it to a Roth to purchase property? Or is it better to use the full amount for better leverage and pay taxes later? Ooh, great question. Jody, it depends. And I know that answer sucks, but it really does. So let me hit a couple things in here. When you say cash out a 457 account, I'm really worried that what you're talking about is taking a distribution. I never want you to cash out a retirement account. Don't ever do that. Don't ever take a distribution. If you want to self-direct it, like you're talking about here, and buy a property, maybe real estate or other alternative investment, you want to roll it over. You want to do what's called a direct rollover from the 457, which is traditional funds. They're pre-tax dollars, but you would roll that traditional 457 set of funds to a traditional IRA. And that traditional IRA can be used to go out and purchase real estate or do other alternative investments using a self-directed IRA. That's what we do every day at Directed IRA. But if you want to do Roth, that's another question. So the first step is I need to move the 457 to a traditional IRA. And I can start self-directing and buy real estate, but would I rather do it in a Roth account? Well, you can convert that 457 to Roth dollars. So that 457 goes to a traditional IRA, and then the traditional IRA is converted into a Roth IRA. Now, there's no tax or penalty going from 457 to traditional IRA, but if you want to convert from traditional IRA to a Roth IRA, you have to pay taxes on the conversion. So let's say that you had 100 grand in the traditional IRA that came from the 457. If you want to convert that to Roth, you're going to take $100,000 into income. That 100K is going to go on your tax return. If you're in a 30% federal tax bracket, 5% state, you're going to pay $35,000 in taxes. So you'll still have 100K in your Roth, but you're going to have to find out 35 grand to send to the IRS into your state. So that kind of sucks, right? But now the Roth account is growing totally tax-free. Now, if you turn that 100K into 150K, I don't know that the Roth conversion matters, frankly. I don't know that it made a big deal. But if you can turn that 100K into 500K or to $1 million, which I think is totally possible over a 10 or 20 year investment cycle, it's a no-brainer to convert to Roth. Because now when I pull out that $1 million in retirement, I pay zero tax on it. If I left that account as traditional and I built that 100K of traditional into $1 million, now that traditional is paying taxes on the way out. If I'm in that same 35% federal and state tax bracket, that's $350,000 going to the IRS in the state. Now, yes, it's coming out later. It's deferred. I get that. But so that's what you need to think through. I'm going to actually do a calculator. I'm going to do another YouTube live on whether to convert or not. And I'm going to show you the dollar savings based on your tax bracket and the growth you need to where the Roth pays off. But if you're not going to really grow it in a significant way, it's kind of a break even. It's not a definite convert to Roth. But if you're going to get 5x returns over 10 or 20 years or more, it's a no-brainer to me to do the Roth IRA and pay to do the conversion. All right, JD Lindsay asked about her IRA LLC in Illinois. Does it need to file a tax return? I've heard conflicting information. Okay, if you have an IRA LLC owned by one IRA, so it's a single member LLC, there is no tax return required with the IRS. As long as the LLC was set up right, if you used our law firm to do it, it'll be set up right. There's no tax return required with the IRS. Now, you do still need to file documents with your state to keep the LLC active. Some states like Texas or California require a franchise tax filing. Even though there might not be any franchise tax due like in Texas or in California, it's a minimum $800. That's a state requirement though for an entity. But there's no federal tax return required with an LLC. In most states, there's nothing required. You pay your $50, you check the box on some forms, and you're active and good. And so in Illinois, JD, no federal tax return, again, if it's just a single member LLC, one IRA owning the LLC 100%, but you will need to keep the LLC active with the state in Illinois. So make sure you're doing that renewal paperwork with the state of Illinois. All right, you let me know if there's any live questions, Tristan. I'm going to keep rolling. Okay. All right, we got a lot more on YouTube here that I need to catch up on. So this is from Rod1021, says, could I as a parent invest into a Roth IRA for a minor, or does the minor have to be employed? Okay, great question. You can do what we call a kid's Roth IRA, and we love kids' Roth IRAs where you can have a kid who has a Roth IRA account and they can start investing and growing that and building up this tax-free wealth, even at 10, 12 years old, or even earlier than that. But the kid must have earned income. Okay, attribute to a Roth IRA, any owner of a Roth IRA, whether it's a kid or an adult, has to have earned income. So, Rod, I don't know in your situation if your child has earned income. If you're a small business owner, even if you just got a side hustle or rental properties, let's pay them out of the side hustle, small business, big business. I don't know your situation, or even your rental properties. Let's pay them some income, which you could take an expense for, by the way. And then they get that in their bank account. They'll need their own bank account for this. And then they can contribute to the Roth IRA. So it's a great tax strategy because you get a deduction and expense in your business to pay them. Now they need to be involved in your business. They need to freaking do something. Okay. We're not just talking about laundering the money here for no good reason. They are really involved in your business. I think it's an awesome way to get your kids involved in your business. Anyways, I did Roth IRAs for my kids. You know what my kids did for years? They cleaned my office on weekends. Okay, they did social media, they show up at events and sell books. And so they were actually getting paid in the business. I was taking an expense, and then I made contributions to their Roth IRAs. So they do have to have employment, but they could have a summer job. They could do babysitting. They can have a part-time job and and even though they're spending all that money, you can still give them that money. Let's say they made $5,000 through the year at a part-time job, but they blew it all on, friends and food and all this stuff that teenagers seem to blow their money on. But they still had 5,000 of earned income. You can then drop that 5 grand into a Roth IRA. All right, we got a question there, Tristan?
Yeah, we did get one more question on YouTube. Matt, please confirm that one can move the entire amount from traditional to Roth at any time of the year, but can postpone paying the tax on it till the next year.
Okay. So you can convert from traditional to Roth now. Let's say you wanted to do that now. Okay. You request the conversion now, and then your money's now Roth dollars. Now start investing that. Now that money's growing tax-free, right? There's no tax now on the way out. Now at the end of the year, you're going to get a 1099-R from your IRA custodian. So if you did it here at Directed IRA, we're going to send you a 1099-R in January, or any other custodian will do this before January 31st. And then that 1099-R is going to get picked up on your tax return in 2025, which you'll have to file by April 15th, 2025. And so the tax is due later in the year. Now, you may want to file an estimated tax on that. I don't know your full tax situation, if you're a business owner or not, if your income fluctuates or not, but there is an estimated tax you could file at that time you do the conversion. Otherwise, honestly, what most people do is they just pay it at the end of the year. Or excuse me, they pay it the next year when they file their return in the following April 15th of the year. So there's no requirement to pay it immediately. In fact, I don't like you taking a distribution of the retirement account dollars to pay for the conversion, because if you're under 59.5, by the way, you're paying a 10% penalty, and you're taking into your taxable income, which is just, and it's reducing the amount of money you can convert to Roth anyways. So don't pay the tax out of the conversion amount, pay it with separate funds. And that's going to come around April 15th of the following year. Have another live one?
Yep, we got another one. Okay, so this one's from Aldo212. What determines how many LLCs I need if I have multiple streams of income? And like investing in real estate, and he has his own small business.
Okay. If you have multiple things that are going on, and this is common, let's just look at the trifecta here for a moment that I had up on the whiteboard. So let's say that you are I'm trying to think the last client I talked to. Let's say that you are a dentist, all right? But you also own rental real estate, okay? I've spoken to a lot of dentists. The Real Estate Investing for Dentists, by the way, is a great organization, awesome Facebook page. I spoke at their conferences. That's really what it's called. Real Estate Investing for Dentists is an awesome, powerful group. But they have, so like if you're a dentist, you should have an S corporation. Okay, I'm going to be talking about Jill Biden's S corporation in another video. I've talked about Joe Biden's S corporation. Every small business owner should use an S corporation for their operations. If you're making more than $40,000 a year, an S corporation will save you on self-employment tax. Okay, this is 15.3% you pay when you're making money from selling goods or services. So let's say you're the dentist, realtor, acupuncturist. I don't care. You got a donut shop, whatever. You drive Uber. These are operational businesses. You're selling goods or services. Then on the other hand, you've got rental properties. Well, I don't want to put those in the same entity. There's different tax considerations for them, and I don't want all my eggs in one basket. If I'm the dentist and I got some patient that sues me for a toothache or something, I don't know, and then I've got rental properties, I don't want those in the same entity. Then that patient could get at all of my assets. So we want to hold our assets separately. That's why we separate assets and operations. That's one reason why. And so we're going to hold our rental properties in a separate LLC. Now, we have a lot of clients that are like, well, Matt, I own 10 rentals. Should I have 10 LLCs? Well, that depends. So if we look at this here, this is a really common question, is how many LLCs should I have for my rental properties? It really depends on your situation. And we're going to look at how much equity do you have between those rental properties to determine how many LLCs you should use. So for example, if you've got 10 rentals, option one would be 10 LLCs. Well, I don't love that because that's super expensive, a lot more management, and it could be overkill. What is really at risk though? It's really only the equity in your properties that is at risk. So if I've got 10 rentals and I've got $10,000 of equity in it, and let's say something goes wrong on property number 7, and they're all owned in one LLC, okay? I've got 10 rentals here. Just imagine that this is 10 here. Don't make me write them all out, okay? And something goes wrong on property number 7, well, they can sue the LLC. This is number 7 here. they can sue the LLC and they can get at the assets of the LLC, but they can't come down to me personally. They're stuck at the LLC. So if all 10 properties in that LLC are really at risk, well, if there's only 10,000 of equity on each property for a total of 100 grand, really no plaintiff's going to go after that. Foreclosing on 10 properties to get 100 grand, frankly, with all the fees and everything, they're not going to get anything. There's really no equity there to protect. Now, I might have been stripping out the equity and I'm obviously taking the cash flow from the LLC bank account and paying down the debt, or I'm taking it to me personally, or I'm using it to buy more assets. And so I'm not leaving cash up here in the LLC. Okay, we don't want to do that because that could be exposed from a lawsuit. So we're keeping cash in the LLC bank account enough to operate the business, cover any unexpected expenses and things like that. Just operating capital is really all that we're doing. So, so what we do like to say though is every 200,000 of equity, we think it makes sense to do a new LLC. So for example, let's say you just had 2 properties. Okay, this is your LLC, this is you, and you've got 2 properties here. And let's say that each property has 200,000 of equity each. Let's say it's 250K. And that's 500,000 total. But if something goes wrong on property number 1, they can get all the equity that's in property number 2 as well. I've got 500K of equity here at risk. So in that instance, we think it makes sense to do 2 separate LLCs, one for each property, because I don't want to have all my eggs in one basket. I want to separate the risk of each property from the equity that could be exposed from each other. So that's why we might use separate LLCs for separate properties for you real estate investors. It's not about how many properties you have, it's about how much equity you have between those properties that determines how many LLCs we're going to use.
Okay, we'll kind of stay on topic with this next one. Rob99 on YouTube is asking, does keeping my name off the LLC filing protect me from an attorney piercing the veil on my personal assets?
Okay, good question. No. Your name, and this is where we say asset protection and privacy are 2 different things. When we think about not having your name on the LLC and talking about Drake here and how he blew it by putting his name on it, he didn't blow the asset protection. He blew the privacy planning, okay? Because his name's on it, so we know who owns that LLC and we can see all of Drake's stuff and what he's doing. And frankly, all of his dirty laundry is getting aired right now on social media. You know, you can go down that rabbit hole if you want. I don't necessarily recommend it, but it was a great lesson on LLCs and what not to do. So now the asset protection isn't blown, okay? Because what happens in that LLC, if he has a lawsuit in there that's legitimate, they still can't come after his personal assets. Or if you look at his org board, if we show that here, go pull up his org board. Now it's 23 other entities. If something goes wrong in this Silence Policy LLC, they can just sue Silence Policy LLC. Okay. They can't get after all of his other LLCs or any of his personal assets. Okay. They're going to get stuck in this LLC itself. Now, if the actions were criminal, and I don't know that that's the case here, I'm just saying, for example, then they could go through the LLC because criminal activity is not protected by the LLC. And so they could blow through the LLC and to get into the other assets. So, but no, just listing your name on an LLC is not going to blow the asset protection. Remember, my name's on my entities with the state because I'm part of them. I want people to know that these are my entities. I'm not trying to get around anything, and I'm not really concerned as much about privacy, but it doesn't blow my asset protection. If someone still sues the company, they can't come after me. Okay, they get stuck at the company level. All right, any other live questions there?
Yeah,
that was a great question right there, though.
Yeah, we got a couple more here. Alexei from YouTube is asking, how does the IRS really scrutinize kids' income? What proof do they need? Do they interview kids in case of an audit?
Good question. We have not ran into getting audited yet. I do know that some IRA custodian providers like Fidelity, for example, will only let you do a kid's Roth IRA if the kid has a W-2 or 1099. And so a lot of our small business owners pay their kids through their family business or their family management company in a legitimate way. It's on their tax return. They take an expense. They book it as outside labor, but there's no W-2 filed. There's no 1099 issued to the kid. And the kid's under the standard deduction, so they don't file a tax return anyways because they didn't make more than $13K or whatever the standard deduction is at now. And so, so there's, for a lot of family businesses, there's no paper trail. Now, if there was an audit, the IRS would look at the family management company. Was this expense, these services expense during that business, which it would be if you did it right. And then they're also going to look at the bank account and transaction history. Did that company pay the kid, which it needs to hit the kid's bank account? Now, you can then take the money from the kid's bank account and transfer back to your personal account because you're a joint owner on your kid's bank accounts usually, and that's totally fine. They're reimbursing you for all the expenses you pay for them. Their soccer, their dance, their whatever they're into. And so, or you're putting it into their Roth IRA, you know what I mean? But you do need to show that trail of the money hitting the kid's bank account. So they will need a bank account or at least a savings account to receive the money to do it properly. So a directed IRA, we don't require a W-2 or 1099, but it is upon the guardian of the child to affirm that they do have earned income. And I haven't seen that audited, so I hope that eventually it's going to happen. Someone's going to audit on this. We're going to have a case about it, but we haven't seen one yet.
Well,
all right.
Maybe they can be the guinea pig, right?
Yeah.
All right.
No one wants that. No one wants that.
We got one from YouTube from Vet Real. He asked, how do I create an LLC for out of US rental property? And do I even need it?
Good question. If this is owned in an IRA or retirement account, you're going to need a US LLC, and then that US LLC will then go own the foreign property. And many times it's actually going to own a foreign entity. So this is where there's, all the different countries have different things. Most country has some type of equivalency to an LLC. And so you're going to use a foreign LLC in that country. So, but every country is a little unique. For example, Mexico, just south of the border here. If you want to own property in Mexico, you're going to actually need a trust. Particularly if you want to own it on coastal areas or some designated areas, non-US citizens non-Mexican citizens cannot own real estate in Mexico except through a specific trust, through a bank that you have to use to do it. And so you can still have an LLC involved in that. But every country is going to be different. So it's a hard question to answer. But typically, you're going to have a legal structure in that country, and you're going to need to deal with legal counsel in that country or some real estate professionals that understand the structure that you're going to need in that specific country, because it is different country to country. The rules on whether non-residents of that country or citizens of that country can own real estate. Sometimes it depends on where the real estate's owned, and then you're probably going to want an entity in that country anyways, just for asset protection too. If you use it for rental purposes or income purposes. If you're like, this is just personal use, you may not need an entity for that. There may be other mechanisms like trust or things that you can use in that country to just own it directly in that mechanism. So it's a hard question to answer. I can just say for at least Mexico, most of the clients we see are using trust down there because they're non-Mexican citizens. That's the only way they can own the property down there. And they have a US LLC in the middle there that receives the income coming back into the US, pays the expenses and stuff. And so hopefully that helps.
Okay. We got another one from Instagram. So tough one
right.
here. When is it too late to do asset protection and privacy protection?
Ooh, great question. When is it too late to do asset protection and privacy protection? Well, if you've already set up the entity or you already have a lawsuit or liability, the horse is out of the barn, so to speak. Okay, it's too late. You can't get the horse back in the barn, really. I mean, I know you could, working with the metaphor here, but it's too late. So you got to do prospective planning on this, because if you already put your name on an LLC, let's say as the manager, and now you're like, damn, I don't want my name on there. Maybe I'm going to go do this Wyoming LLC strategy, like you said, Matt, and then make that Wyoming LLC the manager of my LLC in Colorado or wherever you're at. And then that way, no one in Colorado knows who owns this because I'm not listed as a member. I'm not registered agent, but I am manager. And so you could do that. And again, maybe privacy is important to you. It's not for everyone. But if that is important to you, you could then fix it moving forward. But there's still that history if someone really dug through the prior history of the LLC filings to see that you were an owner. So we would just kind of weigh that in your situation, and we could help amend it and fix the LLC moving forward so that no one can pull it up immediate direct ownership now. They'd have to go through the back channel of it. And sometimes that's pretty good too. And different states display information differently to the public on their website. So that's one option you could do, is come back and do it. Now for asset protection, let's say you already have a lawsuit and you don't have an LLC or anything like that. There's nothing you can do. Asset protection has to be forward looking. You can't go set up an LLC or structure once you're already sued or a liability has arose, nor can you move assets around. Let's say you have an LLC where you have a liability and you have a lawsuit going on or a potential lawsuit, and then you move all the assets out of the LLC over to another LLC. Well, that's called a fraudulent conveyance. You cannot move assets around once a known creditor, a known debtor, a potential debtor here, excuse me, a potential creditor here, not debtor. You would be the debtor if you lose the case. A potential creditor here is around. And so I've even had cases of this, by the way. I represented a real estate investor client who had lent money to another real estate investor who was flipping properties. So my client was like the private lender and didn't secure the loan on the property. Now, what happened was this investor sold the property and then repurchased other properties. So my client went and got a judgment against her, this real estate investor that was the borrower, and won. We won on the judgment. Okay, we got the judgment. It was, let's say $100,000. I forget the total judgment amount. But then we tried to collect on all the assets. Well, this real estate investor was like, well, I don't own anything in those LLCs anymore. I've got them in these other LLCs that her freaking kids owned. And she thought she was being all cute about it. Well, we took her to court. The judge berated her in court in what's called a creditor-debtor exam and basically told her those were what's called fraudulent conveyances, and she had to satisfy the judgment immediately, or he was going to let us attach the properties that were purportedly now owned by LLCs of her kids. And so once you have a liability, moving stuff around and things like that is not smart. You cannot do that. It's not going to get around a judgment or anything that you legally owe. So just be careful. Asset protection planning is forward looking. If you set up the LLC and then the day after, and you get it all in order, the day after a liability arises, you're good. Okay. But we can't go backwards to try and save it. The only option you have there really is a DeLorean, plutonium, 1.21 gigawatts, 88 miles an hour. Back to the Future. I watched it this weekend with my stepdaughters. It's pretty sweet. They hadn't seen it, so I had to make sure they got that. So, all right, let me hit any questions here from YouTube. I got a couple more here. Let's see. Okay, this was from Sonia. Sonia asked, what are the rules on Roth IRA contributions for people who max out their 401k, but make less than the max for high income earners? Ooh, good question. Can you still contribute to a Roth IRA if you contribute $100 less than the 401k max contribution? Yes, you could. There's kind of a very narrow group of people who fall into this because most people who max out their 401k are high income earners. And you can even do, by the way, the mega backdoor Roth, which is probably easier, which is basically an after-tax contribution into your 401k that could be easier. We're going to shoot another video on that. We've got different podcast episodes on the mega backdoor Roth 401k. But can you put the $7,000 a year into the Roth IRA? Yes. Yeah, you could. You could still have the $7,000 in a Roth IRA. Now, the caution, because so many people screw this up, is high income earners. If you're making more than, I don't know what the max is right now, but for Roth, let's look that up. Someone in the chat, maybe Jared or someone in the chat could look that up. What's where do you start phasing out on Roth IRA, where you need to do a backdoor Roth IRA? Let's drop that number in there so everyone knows. But for people who max out their 401k at work, again, they're usually high income earners. We tell them to do a backdoor Roth IRA just because it's going to make sure they don't phase out on the income. But if you're maxing out, but maybe you're making $100K a year, you still got plenty of room before you're phasing out. You could also do your $7K a year into the Roth IRA.
161 single, 240 married.
There you go. Perfect. So that's possible. I guess I could see someone making $150K a year, maxing out their 401k, or maybe you're just a super good saver, maxing out the 401k and living off the rest. So if you're under those numbers, yes, Sonia, you could just do the Roth IRA directly. You don't have to do the backdoor Roth. For anyone over those numbers, you got to do the backdoor Roth IRA. Make sure you watch other videos. We've got podcast episodes, a lot of content, of course, on how the backdoor Roth IRA works. All right, we've got a live question there.
Yeah, this is an interesting one, Matt. We might stump you here.
Oh, great.
Gary asked on YouTube.
Warning me here.
I'm setting him up.
He knows after this, somebody will be like, why'd you ask that question? Holy cow.
Exactly. Can a self-directed IRA trustee have an indexed universal life policy and use a loan from its cash value to buy real estate?
No. Self-direct IRAs in general cannot own life insurance. They can't. It can own an annuity. So, but IRAs cannot own life insurance. 401ks can. So, and when it says trustee, by the way, a self-directed IRA, does it say IRA or 401k? They said IRA. Okay. The trustee of an IRA is your custodian. It's like if you have an IRA at directed IRA, directed trust company is your trustee. Okay. So if you have a 401k, like a solo 401k, for example, you can be the trustee. But for IRAs, the trustee of an IRA has to be a bank, a credit union, or a trust company. And we're a trust company. These are all audited, regulated places. And so, but IRAs just can't own life insurance. Now, they can own annuities. I don't recommend an annuity because annuities have other tax benefits to it. Putting it in an IRA on top of it is like wearing a belt and suspenders. It's just like, it's unnecessary. If you want to do annuities, it's not my thing, but like if you're into that, just do it outside of the retirement account. Use the retirement account to invest in other assets besides life insurance products. So, but there's different opinions on that. I see zero reason to do that. And again, you cannot own life insurance in an IRA, but you could own an annuity. So I don't know if this is an annuity question, but I heard the word life insurance, so I went down that route. Okay, here's a question that came in from Riley. Riley says, my husband and I are in our late 20s, early 30s. We are currently in the process of building our own business. We have the same vision of what we want for our financial future. But when it comes to investing profits, my husband tends to focus all the money back into growing the business right now. So any retirement investing or alternative asset investing takes the back burner. At what point do you think it's important to shift focus from growing the business to investing in other opportunities? Is there a certain growth checkpoint in the business that we should reach first, or should that be done from the beginning? Dang, Riley, this is a great question. This is the question of the day, actually. This is the question of the year. This is the question you will ask yourself in your 50s and 60s, Riley, when you're still trying to grow and build that business. And then you're thinking about, how am I going to also invest it? I think you gotta have to take a measured approach to this. I can see your husband's point of view, and this is going to, by the way, I'm going to go back and forth here because there's not a clear answer on this. I can see your husband's point of view. The most valuable use of the profits from our business is putting it back in the business to grow it. Now, I want you to be super intentional about that and know, what are you getting from that? Are you reinvesting that into your business to get more profit later? Because what happens eventually is you get into this cycle of reinvesting all of your money in your business. And I run into business owners in their 50s and 60s. They're like, I have nothing saved. Absolutely nothing. I own my house and my business, no investment account, no retirement account, no 401k, no IRA. I'm a small business owner. I put all of my money back into my business. And it's kind of sad because if that business fails, they have nothing. Now, on the other hand, that could be the most valuable use of the $100,000 of profits in your business, is using that 100 grand to invest back in yourself and your own business to grow it. I get it. I'm faced with this same dilemma, Riley. So I would take a measured approach to that and to taking a little bit of money off the table. Now, maybe you're making 100 grand in profit. And by the way, when I say profit, I'm talking about you're paying yourself too in the business. Okay. Like you're taking a wage, no matter how you're doing it for tax planning purposes. I'm just saying, maybe you're like, I need 50K a year. I need 100K a year to pay the bills and live. After that, the real profit you're making, the real profit of the business, maybe you just take a measured approach and say, you know what, we're going to take 20% of that and we're going to go save and invest it. We're going to use retirement accounts, or we're going to do other non-retirement account stuff. We're going to go build wealth outside of the business so that we have other things to rely on. Maybe it's rental real estate, maybe it's other alternative asset investing, but we're not going to plow 100% back into the business for 20, 30 years and then run at the end of the day of our business that may be irrelevant at that time. I don't know. I mean, I honestly, I had a client that owned Hollywood video stores, right? They own Hollywood video, like those just don't even exist anymore. Everybody streams now, right? And I don't remember their total financial situation, but let me just say it wreaked havoc on their lives because their business was now obsolete. And so I want to just be careful about reinvesting everything into the business. So I would maybe say, let's set 20% aside. And I think that could be an easily negotiated thing. And maybe at some point you might get, let's take 50% and we'll reinvest 50% in the business. The other 50% we'll set aside to invest in other assets. So I would look at that. Now, Eventually, if you're crushing it, Riley, and you're in your 40s or your 50s, and you've really been investing back in your business for 20 years, it better be generating significant profits where you're not going to have this issue, where you're going to have plenty of money to set aside and invest and have money to grow the business in a moderate way or a significant way for the next 20 years. You may want to run that thing. And so, but I get it, in your late 20s and early 30s, your most valuable use might be reinvesting in the business itself. Again, maybe you take 20% and set it aside. I don't know. As you can see, I've struggled with this myself. I've taken a moderate approach that when I had enough income, I started maxing out my retirement accounts and starting investing those, acquiring other real estate rental assets, even though I'm still reinvesting in the business. But what did I do in my 20s, in my late 20s? I was doing what you're doing. I was reinvesting in myself and my own business at first to get greater income to where I could save and then invest. But don't get on the hamster wheel of just putting every penny back in the business, because when you're in your 40s and 50s, this is going to matter more. You're going to need to start making sure you're setting money aside. All right, well, it looks like we might be up against the time here. So unless we have any other live questions, no other live questions?
We do have one. It's a follow-up to the IUL question.
Oh, gosh. Okay. All right, let's hit it. I'm not an expert on IULs, so let me just say that first. But let's try the question.
So Gary said, I meant rolling over a Roth into an IUL, then using the loan to buy my personal home. Is there no way to have the privacy and asset protection for that situation?
Okay. Rolling over a Roth to buy an IUL sounds pretty dumb. Why would you take money out of a Roth to go buy a life insurance policy? The Roth is totally tax-free. You're going to have to take a distribution of it. When you say roll it over, they're going to take a distribution of this thing. That Roth account is a tax-free bucket you can use to invest in anything and grow it and come out totally tax-free. I'm going to go use it to buy a life insurance policy so I can lend myself money? What? Why? I don't understand why you would do that. If you're going to go buy an IUL or some type of life insurance policy that operates like an investment, then go do that with other money. But don't raid a Roth IRA, money that's tax-free, that's limited on how much money you can get in there, that the IRS is trying to shut down because it's such a powerful tax-free wealth building tool. Don't raid that. That's the last place I'm going to look to fund an IUL. The only person that would tell you to do that is someone that freaking sells IULs. Now, if you want to do an IUL, cool, do one. I'm going to frankly look into this and do one for myself. I've told my team here, I'm like, guys, I just don't get it with this bank on yourself IUL stuff. I can put money into something, a life insurance product, and then lend it back out to myself. Why didn't I just keep the money in the first place? Well, the life insurance company's going to go invest it and they still get to grow it. And then I'm paying interest back. So I'm betting on the life insurance company beating the market than what the interest I'm paying. It just doesn't, I don't understand why that is such a amazing investment philosophy. And the last thing I'll say on this, and I'm going to come back, by the way, I'm going to do a video on this because I'm going to go, and I'm hoping to be wrong on this, by the way. If I'm wrong on this, I'm going to start selling life insurance. But if I'm wrong on this, on the IULs, I'll come back and tell you, but I'm going to go shop this. I'm going to go get a policy for myself and I'm going to see what it costs and if it makes sense. That's the only way I know how to do this. Because every time I talk to someone about it, they talk about theoretical stuff. No, let's get specific. I'm 43 years old. Here's my stuff. Let's go figure it out. What's the policy I can get? And I'm going to see if this strategy makes sense or not. I'm just going to do the math and I'll come back and report. So maybe more to come on this right now, but definitely do not use your Roth IRA money to do this. Do not take a distribution out of that. That seems idiotic. If you want to do an IUL, and I'm not saying you should, go use other money outside of your retirement account to fund the IUL. And the last thing that I will say on this in an IUL is, guys, I've had the time to do the 10,000 consults. I've met with business owners, real estate investors, people that have real wealth, freaking transformational wealth for their family. Do you know how many clients I have came across? And I've had thousands. I've met thousands of millionaires. Do you know how many clients I've came across that became wealthy because of an indexed universal life insurance policy? Zero. The three things people had that they did to become wealthy: business ownership, real estate investment, and retirement accounts. Those are the three buckets of wealth that real people in America have that have created real wealth. I have not met someone that became wealthy because they bought life insurance. I just haven't. So I'm going to come back on that one though. That's on my list. Sorry, that was a little kind of, opinionated answer there with not a lot of detail. But I'm going to go do my little research on it. And I'm going to go try to get an IUL policy for myself so I can tell you, and maybe I'll be wrong. I'll be the first one to tell you I did it wrong and I'll start selling IULs. All right. Well, thanks everyone for being on live with me today. Please get subscribed on my YouTube channel. We'll be coming back next week, of course, with another amazing episode of Team Wealth Live, giving you strategies to save on taxes, protect your assets, stay private, not be like Drake, and how to build for retirement you're looking forward to. We'll see you next time.